Good afternoon. This is David Stern. I'm the Director of Investment Research here at First Western Trust. Joining me today are John Sawyer, our Chief Investment Officer, and Karen Post, our Managing Director of Equities. For the next 20 minutes or so, I'll be asking John and Karen for their thoughts on various topics, including the domestic and global economy, equity markets, the Fed, and interest rates. And then we will conclude with some final thoughts from John. So without further ado, let's just dive right in. The first topic I'd like to discuss is the U.S. economy. So starting with our outlook for 2020, we saw GDP growth accelerate in 2018. We saw that then moderate in 2019. What are we thinking for 2020?
Sure. Thank you, David, and welcome everyone. I guess just not to bury the headline, and we will talk later on the call about some of the near-term impacts of the coronavirus and other timely issues. To David's question, just in a big picture perspective on the U.S. economy, we continue to be faced with lackluster overall economic growth that are tied to structural issues that we've really not been able to improve upon over the past couple of years. Namely, productivity on the whole across the U.S. economy has not improved in a meaningful way, and we have slowing growth rates from a birth perspective and population growth perspective. These are significant headwinds for the economy, and obviously not easily solved. One of the catalysts for supporting or for implementing the 2016 tax changes was to address productivity, but as of yet, we've not seen a follow-through from corporate America to drive those improvements. Our perspective and outlook is not dissimilar from what it was in 2019. We're expecting a kind of 2% on average growth for the year with a range of 1.75 to 2.25% growth going forward. We also don't expect meaningful changes to the interest rate structure in 2020, so not unlike what we saw in 2019 as well. While it continues to confound economists and frankly us, the employment picture is very good in the United States, but that has yet to translate into any inflationary pressure. And without some increase in inflation overall, it's unlikely that we're going to see an increase in rates. And so with rates being stable, and that is very consistent with the slower growth rate of the economy, we see largely in trend line stable growth for the forthcoming year.
Great, thank you. Karen, oftentimes during our IPC meetings, you'll talk about high frequency indicators. For the audience, what are some examples of those indicators and what are they telling you right now?
Sure, the first I look at would be railroad or rail car traffic. And this is reported weekly by the Association of American Railroads. Warren Buffett famously once said that if you were stuck on a desert island and allowed only one number to gauge how the economy was doing, he would pick rail car traffic. And even in today's more service-oriented economy, it still has relevance, has a high correlation to the quarterly GDP changes, and really just gives a good read on broader industrial trends. Last year, we saw rail car traffic decline throughout the year by about 4 to 5%, and it has continued to decline this year as well. So kind of mirroring the softness that we've seen in the manufacturing sector. A second example would be loan growth. The Federal Reserve Bank publishes weekly a detailed aggregated balance sheet for all commercial banks in the U.S. And this report specifically details various loan categories such as residential mortgages, commercial real estate, consumer loans, and commercial and industrial loans. And it's this last category, the C&I category, where we saw growth slow throughout the year last year, and actually in the fourth quarter last year, growth turned negative for the first time in about 9 quarters. So again, some higher frequency data mirroring the softness that we've seen in the manufacturing and business spending areas.
Great, thank you. Shifting to the global economy, this question is really for both of you. 2019 was dominated by concerns about trade, and we've certainly seen those recede. following the phase one trade deal signed in mid-January by the U.S. and China, but those concerns have been rapidly replaced by those of the coronavirus. So I guess my question to the two of you is just how serious do we think this is, and what do we expect the impacts to be?
So I think first, it's obviously very early in the evolution of this flu epidemic in China to really determine what the ultimate outcome is going to be. We have some precedent to look back on with the SARS epidemic and then the MERS epidemic, and kind of what the evolution of those were, and ultimately what the impact from an economic perspective was overall. Our expectation now, again, albeit being very early, is that it will probably be something like those two epidemics, where there will be somewhat meaningful isolated economic impact, but not as much to the global economy overall. That could obviously change, within the next few weeks if this begins to spread in a more rapid fashion. One of the interesting, probably unintended consequences that we've been looking into is the changes that companies went through over the past couple of years with the ramp up of the trade tensions with China, in particular U.S. and China, and the diversification of the supply chains. And that has helped really give more offset to the potential impact of the Chinese kind of concentration of manufacturing on a global basis. And so that could mitigate to some degree the effective shutdown of the regions in China that are most affected right now. But largely, I think we're somewhat in a wait and see mode.
Yeah, I would just add that today China is a much bigger percentage of the worldwide GDP. It accounts for about 20% of worldwide GDP. That compares to about 4% when the SARS crisis hit. So, China obviously much bigger today, and supply chains and manufacturing, a lot more companies dependent on that region.
Great, thank you. So shifting geographic region here, just briefly I'd like to get your thoughts on Europe, and specifically why growth has been so lackluster in that area.
So from a European perspective, to David's point, the region as a whole has really underperformed significantly from an economic growth perspective, really since the financial crisis. Although they did post fairly decent equity returns on the whole last year. The continent's activity from an ECB or European Central Bank perspective, as well as the central banking activities within the individual countries, has been somewhat, I think, counterproductive to overall growth, in that they have tried to maintain, I think, responsible budget policies on the near term, as they came out of the financial crisis, which inhibited growth, where we were much more in the U.S. Proactive in providing liquidity and support to the markets, and so that kind of set them behind us initially, and then I think the low growth has really fed on itself since that time, and really mitigated the opportunity for them to improve their economic circumstances. Over the past couple of years, what we've seen is of probably all the countries in the world, Germany has been hit the hardest from the trade tensions overall. And so if maybe kind of keying off of Karen's comments, if you had one indicator to look at, if you had one country to watch in Europe, it would be Germany. And as Germany goes, the rest of the continent will likely follow, and they are in a somewhat precarious situation right now. And so until they can kind of fix their output, you're not going to see much resolution across the continent. And then the other, I think, big headline issue obviously is Brexit, and there's been considerable uncertainty and unpredictability, frankly, with the Brexit situation over the past 2 years. There seems to be some finalization of that with a little bit more stable clarity as we look forward, and so that could provide a little bit more of a tailwind to those related assets as we move forward.
Great, thank you. Karen, I want to turn to you and talk about equities for a few minutes here. Following the strong performance in domestic markets here last year, current valuations are now above some of their longer-term averages. Should we be concerned about valuations at current levels?
Well, when we talk about valuations, the most common measure that we look at is the price to earnings ratio, or PE for shorthand. And that's just simply the price of a stock or market index divided by the earnings per share. So if a stock was trading at $100 and was expected to earn $5 a share in earnings this year, its PE would be 20 times. Last year, the S&P PE ratio expanded significantly by about 25%. And that PE expansion alone accounted for over 90% of the returns last year. So on an absolute basis, most valuation metrics today do look extended, with levels in the 90th percentile of their historical ranges. But we are still below the highs that we saw back in the tech bubble when the PE was 25 times. The one measure that makes equities look reasonably valued, though, is the one compared to interest rates. And with the yield on the 10-year Treasury at about 1.6%, equities do look attractive. A record 64% of S&P 500 stocks now have dividend yields above the yield on the 10-year Treasury. Inflation is another driver of valuations, and the low inflation levels that we've seen today in the 2% range have historically been supportive of the valuation levels we see today. So on one hand, absolute valuations are a bit high, but compared to the environment that we're in with low interest rates and low inflation, these levels have certainly been supported in the past.
I would just add, kind of big picture, what we generally see is counter-cyclical moves between the bond market and the stock market. And so if the market expectation is for low growth, which is generally coupled with low inflation, you see rates come down and bond prices go up. But then on the other side of that, you have lower equity prices as well, coupled with that because of the lack of belief in growth in the near term. What we have seen over the current cycle now, and kind of in the late stages of this cycle, is appreciation of equity assets coupled with appreciation of fixed income or bond prices. And so, that is of concerning from a valuation perspective, to David's point. But there are some fundamental aspects, namely the ones that Karen noted, that support the thesis of higher equity prices, despite the fact that the bond market is predicting, lower growth and lower inflation going forward. So I would say that we somewhat remain cautiously optimistic, but I will also say that we are careful to not subscribe generally to this time it's different thesis, and so we continue to watch valuations very closely.
Karen, we're now near the end of fourth quarter earnings season. What has the general tone been, and what's your outlook for earnings in 2020?
Yeah, so earnings for the fourth quarter, about 80% of the S&P 500 companies have now reported. And going into the quarter, expectations were for in aggregate earnings to be down 1%. Earnings have been coming in better than expected, and now growth is looking like to be a positive 1 to 2%. So this would be the first quarter of quarterly growth since the fourth quarter of 2018. So in investors' minds, an inflection point has been reached in the earnings cycle, and that's certainly a positive. Earnings for this year, consensus is looking for about 8% growth. Probably that's a little too optimistic, as expectations are usually a bit high at the beginning of the year. So growth in the 6 to 7% range is probably more likely. Top line growth or revenue growth should be fairly solid, 5 to 6% as well this year. And margins, we've seen a lot of companies last year get hurt by rising wages, margin pressures from tariffs, and kind of an overall inventory destocking cycle that weighed on the more cyclical areas. So some of those things should moderate this year, which would be supportive of an acceleration in earnings growth. Business spending has been muted and is probably likely to remain somewhat muted, especially in the face of the coronavirus and it being an election year. So I would think that growth in the first half would be slower than the second half, but once the uncertainty is cleared up over the election, that you could see businesses become more optimistic.
Great, thank you. So we'd be remiss to have one of these discussions and not talk about the Fed and interest rates. Allow the bad pun, if you will, but riffing on the classic Clash song, "Should I Stay or Should I Go?" Do you expect the Fed to stay or go higher or lower with interest rates in 2020?
So if we could rewind 30 days, which we obviously can't do, our outlook had been for a very stable Fed through 2020 on the heels of 3 reductions last year. To Karen's point, we have an election later this year, and the Fed generally tries to be, if not at least appear, apolitical in their activities. And so I think the outlook had been, and the general consensus was, that we would not see an active Fed this year. That said, with the uncertainty surrounding the coronavirus, there is growing belief that the Fed would respond if there were significant, expansion of the infection rate of that. And so, depending on kind of where that goes and how badly it affects both global and U.S. economic activity, we could see the Fed step in to try to provide some comfort to the markets. All in all, I think if that issue does not metastasize kind of in a bad path, we'll continue to see a stable Fed for the foreseeable future.
Great. So just to summarize, after such a strong year in 2019 in which we saw asset classes up really across the board, how should folks be thinking about 2020?
Yeah, so again, a few weeks ago, as we were looking at 2020, and I know it sounds a bit cliche-ish, but we were effectively cautiously optimistic, kind of within trend line expectations. So that kind of 2% top line growth, positive equity earnings that improve over 2019, but to Karen's point, not quite as rosy as Wall Street is predicting right now. I'm afraid that we're probably going to move into a period of maybe 30 to 60 days of considerable volatility related to day-to-day headlines that are largely going to be inconsistent and contradictory related to the coronavirus and the companies that are providing insights into their earnings and earnings forecasts in particular of what impacts they think they're going to have. And so our outlook maybe is a little bit